earnings are still going higher and have room perhaps even to be higher than the consensus right now, presumably the overall economy is going to be holding up well as well. Where does that leave you with regard to the interplay of inflation, Fed policy, interest rates, and the economy?
Yeah, it's a very tricky alchemy, because I think that it's very easy for someone to say, oh, well, inflation, if it's up, it's good for earnings, so if it goes down, it's bad for earnings.
Right.
And a lot of people got tripped up on that, because reality is a lot of companies have inverse correlation to inflation. A great example is technology is inversely correlated to inflation. So their margins actually go up if inflation is falling. And with regard to the Fed, again, the Fed it's tricky because it's unknowable. I mean, I have no insight into what the Fed's going to do. But in general, I think that we've been more optimistic that they're going to achieve their idea of a soft landing. So we've leaned that the Fed is more dovish than people perceive.
We actually have a viewer question right along these lines, which is that, shelter costs, of course, a big part of why reported inflation remains as high as it is. And yet a lot of folks don't want to move because maybe high interest rates are holding them back, or maybe that's reducing the affordability. So in other words, would lower rates potentially help the one thing that's keeping inflation as high as it is?
Yeah, I've heard that argument.
Yeah.
I think it's actually really well reasoned, and it's counterintuitive, because you'd think, oh, well, if you cut rates, shouldn't home prices shoot up? But you're right, if it's liquidity that's keeping homes from moving, and a proper equilibrium of housing, it's absolutely dead on. Yeah. And there's also this excess premium right now on mortgage rates. The 10-year versus mortgage rates is almost 100 basis points wider than it should be. So as soon as Fed starts cutting, that collapses and it makes housing affordable.
Yeah, like 2.5 percentage points at this point, I guess, right? Yeah. We have to talk about, I guess, the innovation part of this market, which has been a huge source of energy for the upside in stocks. So we have NVIDIA reporting today, really at the center of this massive investment boom. It's also responsible for a big chunk of the upside for the S&P this year. So how do you handicap where we are in this trend and what AI's payoff is ultimately going to look like?
Yeah. To us, when we did a study looking at what happened, what drives innovation cycles in America. And believe it or not, the two biggest innovation cycles in the U.S., which was 1948 to 57, which was a boom time, and 1991 to 99, were two periods when the world was short structurally of labor. So you had a prime age workforce growing slower than the total population, which means there was a lot of pressure on either wages or ways to innovate to produce more output. We've gone into a period of structural deficit of prime force labor, which is going to last till 2045, which means another tech cycle, I think, is underway. And for viewers, it's not just like NVIDIA makes chips and you got to buy it. It's just that there may be an 80 million prime age workforce shortage globally. That's $3 trillion of wages that won't be spent on labor. NVIDIA's revenues are $100 billion. So to us, this is really early stages for the amount of money that will be spent on generative AI.
So $3 trillion over, what, 20 years that would otherwise have been spent on labor?
And it's $3 trillion a year.
Oh,
so
it's a year.
It's actually close to 6% of GDP.
Got it. Okay. And so that, in theory, would be the source of the investment on an ongoing basis on productivity measures.
Yeah, in simplistic terms, it's taking wage cost to silicon.
Yeah.
Is really the theme.